What is the S&P 500 and how to trade it? Hello everyone. Welcome back to the channel. If you are looking to start investing or trading in the stock market but aren't sure where to begin, today's video is for you. Today, we are going to break down the world's most popular stock market index, the S&P 500. S&P 500 stands for Standard & Poor's 500. It is a stock market index that tracks the performance of roughly 500 of the largest and most financially stable publicly traded companies in the United States. Top companies, it includes global giants like Apple, Microsoft, Amazon, Alphabet, Google, Meta, Tesla, and Nvidia. The economy's mirror, these 500 companies make up about 80% of the total U.S. stock market value. Because of this, it is widely considered the best overall gauge of the health of the American economy. Market cap weighted, it is weighted by market capitalization, meaning larger companies like Apple or Microsoft have a heavier influence on the index's direction than smaller companies on the list. Can you buy the S&P 500 directly? Here is a very important question: can you buy shares of the S&P 500 directly? The answer is no. The S&P 500 is not a company, it is simply a mathematical index. However, you can easily invest in it using financial instruments designed to track its exact performance. To invest or trade the S&P 500. Depending on your financial goals, you can choose one of two main paths. Option A, ETFs for long-term investing, best for beginners. If you want to build long-term wealth or save for retirement, exchange-traded funds, ETFs, are your best option. Popular examples: Vanguard S&P 500 ETF, VU, Spider S&P 500 ETF Trust, SPY, or iShares Core S&P 500 ETF, IVV. How it works: when you buy a single share of an ETF, you are instantly investing a tiny fraction into all 500 companies at once. This diversification drastically lowers your risk, making it ideal for a buy and hold strategy. Option B, derivatives for short-term trading, advanced. If you want to be an active day trader or swing trader looking for short-term gains, you might look at futures and options, contracts used by advanced traders to speculate on daily price movements using leverage. CFDs, contracts for difference popular with international retail traders to go long or short on the index price. Warning: high leverage makes these options much riskier. Essential risk management rules. If you are trading actively, always keep these golden rules in mind. 1. Protect your capital. Never risk more than 1% to 2% of your total trading account on a single trade. 2. Use stop losses. Always set a predefined exit point to protect yourself if the market turns against you. 3. Watch the news. Keep an eye on Federal Reserve interest rate announcements, inflation data, and major corporate earnings reports, as they heavily drive market volatility. Common psychological traps to avoid. As a beginner stepping into the financial markets, managing your emotions is just as important as understanding technical charts or fund types. 2 major psychological pitfalls often trip up new investors: panic selling during market downturns and FOMO, fear of missing out, during rapid bull runs. When the S&P 500 experiences a temporary correction or a bear market, seeing your portfolio value drop can be stressful. However, history shows that the U.S. market has always eventually recovered and reached new highs over long horizons. Sticking to a disciplined, consistent investment routine such as automated monthly contributions helps remove emotion from the equation and ensures you stay focused on your ultimate financial destination. Are you planning to build a long-term investment portfolio, or are you interested in short-term trading? Let me know in the comments below. If you found this video helpful, make sure to hit that like button and subscribe for more finance tips. Thank you for watching.